against sterling.
For more on finance now, Rod North joins you from Bourse Communications. Rod, good morning.
Good morning.
Now, the rates that we're being charged on our mortgages really varying now, depending on where you might be.
Yes, it's going to be very interesting to see, because last week we had one of Australia's largest credit unions, Credit Union Australia, come out and drop their standard variable mortgage rate from 6.62 to 6.37%. So that's effectively the 25 basis point increase from the last Reserve Bank Board meeting. So, and this is really the first time we've seen this since before the global financial crisis.
Bit of competition finally.
Bit of competition coming into the market, so it's going to be interesting to see who else will be flushed out. And I suppose future rate increases, of course, are going to be interesting in terms of that conundrum as to what's going to happen in relation to perhaps the property market that just continues to take off. People seem to be continuing to buy property, not too concerned about the future outlook for rates. But with competition coming back into the market, people are going to be able to get some fairly decent rates.
That's something for people to look forward to.
Some consolation, yeah.
Now, you reckon in the next 6 months or so, we're likely to see some really big bonuses paid out to executives?
Yes, this is a very unfortunate trend in some ways, because many people would argue, well, look, this was one of the big problems that led us into the global financial crisis, but there's about 4,000 finance executives that are probably lining up for some pretty hefty bonuses, and a lot of that's got to do with the fact that the market has performed so well, particularly the share market over the last 12 months, nearly up by 60%. So to retain those people in those current positions, a lot of companies are forced to have to pay pretty hefty bonuses to keep those finance staff.
So you think it's a necessary evil?
Well, I think we've got to watch this trend very closely, because it's okay, I suppose, if a lot of those executives are investing that money back into their own businesses and so forth. But I don't think it's a really good trend, to see, and it's perhaps a bit early in the whole sort of process to see this rear, in some ways, as many would argue, its ugly head again.
It's interesting that I guess we shouldn't be surprised in a way, because I was reading over the weekend that in the United States, in the wake of the collapse of Lehman's and the bailouts to all those banks, Citigroup and the like, not a single piece of legislation has been introduced or passed in the US Congress to make any changes to the way that those sorts of banks and groups do their business, structure their companies, their borrowings, and the financial instruments that they have, stacked up to the gunnels. So nothing has changed.
Nothing's changed, and of course, many of those finance institutions and to some degree banks internationally have been supported, by.
They've received public money.
That's right. So you'd think a bit more time, a bit more passage of time would need to pass, before we get back into this trend again.
You'd hope so.
Now, according to the Reserve Bank Assistant Governor, it looks like we're due for another couple of rate rises in the coming months.
Yes, there's really no sort of new news here, because the Reserve Bank's been very consistent in what it said for some time now, for at least a good 6 months, saying that it's likely that we will move back to a normal setting for interest rates, which is somewhere between 4.5% and 5.5%. We're currently at a cash rate of 4%. So the question is when that will occur, but it may be soon, it may be a bit later, and a lot of that will depend on what sort of things get thrown up from an international perspective, and also in terms of our own economic recovery here.
But if we pull those elements together, what we were speaking about earlier, with there being some competition creeping into the mortgage market and these interest rate rises on the cards, together, that has to indicate then, doesn't it, that there's a very healthy and optimistic outlook when it comes to the state of the Australian economy and its recovery, and more importantly, its growth.
Yes, I think that is very much indicating that that's a good sign. The fact that rates will head back to a normal setting, is indicative of the fact that Australia's in a very good position from an economic point of view. We've got good growth coming through, and then it'll be very interesting to see, once we get through this quarter to June, what our GDP figure will be. But I think it's a pretty rosy picture. But it's a slow recovery. Things don't normally return that quickly, so we're looking to see the market just gradually crawl its way back.
Rod North, good to see you. Thank you.
Thank you.